Two, one. Hi, welcome back to Academic Market Insights. I'm Dr. Russell Rhodes, joined by Dr. Larissa Ademiak. Today, we're going to talk about the Vasicek model. I checked that pronunciation in a couple of places. I think I've got it right. If I didn't get it right, you're going to see it on a slide in a second, so you'll know what we're talking about. It's a fixed income related model. The way that I've seen it, I've seen it shown as a way to kind of value a portfolio of loans. Well, bonds are nothing more than a loan. So Dr. A is going to use some ingenious methods to apply this to predicting T-bill rates. Is that right? T-bill rates is what we're going to do here. You're going to predict real markets.
T-bill rates, though,
Yeah.
traded in the secondary market, which is a little more exciting. And again, we're designing this particular video is a how to develop this model in Excel. And the reason why we're doing this is because it came up in a project that some of our graduate students are using. So we're sharing it with you because that's what we do. If you like this, please hit like and please subscribe. If you have other models, you're like, I'd really like to model that in Excel. We'll help you out there. So please let us know in the comments. And just so you guys know, we're going to toggle back and forth between the deck and the Excel set spreadsheet. I apologize up front. Nothing is necessarily looking very pretty. But the goal and the focus was really so that we could step-by-step procedurally get into the Vasicek model. Okay, with that, let's take a look. And I'm going to share my entire desktop so we can go back and forth. Okay. So the model itself, I'm going to go to our third slide. We're going to look at the model has two components. The first is a mean reverting component, and the second is a stochastic drift. That's the standard deviation times this drift, and that's DZ. So we have this idea that rates will eventually revert to their long-term average. And logically, this is something that we assume all the time. Now, you might think, wait a minute, that doesn't make any sense. Why would we ever consider that? Why would we model things that way? If you think about, and I'm going to jump down to here, this model will give us three different shapes for curves. And we're not seeing all of the curves that could possibly be seen in a interest rate environment, but this particular model will most likely give one of these three curves. So our normal yield curve, upward and sloping, we, for the most part, assume that eventually all of our curves are going to end up looking like this once again. It'll deviate. For example, we'll have something like this, and we've had markets like this very recently. We're in a market where the shorter term rates are higher than the longer term rates. We can have, and this again, these are the three types that the Vasicek model will generate, but we can have even situations where we have spikes in different rates. And we've also seen that in recent times. So again, if you're interested in learning more about that, we have past videos that talk about the wonky interest rate environment that we have right now. So some of these limitations that this particular model has is the fact that we're really going to be, if we wanted to expand this and look at an entire term structure, these are the shapes it's going to give. It's not going to allow for anything else. We're also limited to the idea that really the single factor here is that long-term average. And that's not necessarily the most indicative. Like if you're thinking about from a equity standpoint, it'd be like CAPM as a single factor model, and that single factor being the overall interest rate. And this, our single factor is a long-term or long-run average. Okay. It also allows for negative interest rate, which we don't necessarily get. Sometimes we do, right? Sometimes they appear, but that's not necessarily a desirable quality in a model. So, oh, guess, Dr. Rowe.
Um, sorry for the trick question. Why is that a limitation that it allows
Because
for negative? And the reason I say that is when we got negative interest rates, especially in the Eurozone and in Japan, you would hear these guys on Bloomberg TV talking about how none of our models work with interest rates. We're not used to a negative interest rate environment, blah, blah, blah. So there.
why is it that?
That's the
Yeah.
question. Yeah. Yeah. So
And so part of and I'm glad you're bringing this up. I'm going to pull the book and you'll recognize this book, Dr. Rowe.
oh yeah.
The John Hull book, right? We all have a copy. It's near and dear to all of our hearts. And this was mentioned. I mean, I'll tell you how old my version is. It has my maiden name printed up here. And the reason why I'm mentioning how old this is, when some of these models were being created and developed, we didn't have negative interest rates. It was thought of as something that was impossible. If you go back 15 years, you go back 20 years, we assume that interest rates could never be negative because the idea of being paid, it just didn't make sense. And now we fast forward, we have had situations where negative interest rates have come about. Okay.
And I wonder if that's going to be more prevalent in the future, especially if we have contracting economies because of contracting populations and things like that. I have an old textbook where it actually says that the risk-free rate would never be lower than the dividend yield.
Mm-hmm. Which,
So,
ironically enough, if you're looking at our data, this is 1-year Treasury bill secondary market rate. So this is the traded. You can see that and I'm leaning into the computer, but you can see down here that we essentially have zero rates for quite some time. And getting back to your point, that was definitely lower than the dividend yield. So looking at this data, what I did was I cut off quite a bit of data and I started in November of 22. Okay, so November of 22 is, I think, right around here. And this is the amount of data I grabbed to work with. And part of it is because, and this is important when you're modeling, if we're thinking about a long run average, and we incorporate all of this data that's almost now irrelevant, it doesn't necessarily make sense, especially if we're looking for the next year's prediction. And I did run this model with the entire data, and it ended up giving us a prediction of, I think, 1.36%. And again, and I think this is a really important point with modeling. If it doesn't make sense, it probably doesn't make sense. So it's not worth really presenting. It's one of the reasons why we're not going to talk about it. We're not going to look at it because it just doesn't make sense. So the data that we're looking at is this, just this November 22 through the present. We are going to use the line estimate functionality within Excel to calculate our coefficients of A and then A minus B, okay? We're then going to use that, once we have that data, we're then going to predict our interest rate going forward. We also need to calculate our standard deviation. We will calculate the A and then the B. Our interest rate we're going to use as the current interest rate. So we're going to do all of those things. So to get our A and our B, we're going to first calculate what's called our delta, because the underlying assumption for our model is that it is delta neutral. Okay, so this is a very similar to binomial model. We are forcing this assumption to be in place to hold lines together or to hold prices together. So if we don't, we could have arbitrage opportunities. And once that happens, then we're in a situation where we can't rely on any of these pricing models. So we're using that as assumption. So our delta is the price today minus the price yesterday. Easy peasy. And then we're going to also calculate our lag, which is yesterday's price. So I'm going to quick toggle over here. And you can easily see that this is yesterday's. And that the lag is simply the price from the day before. Not too bad. We're then going to use the line estimate functionality. And we do this because it's an easy way to get around, how can I say, get around using the regression model. So we want to pull that information out. We don't necessarily need to run the regression. We don't necessarily need to see all of the other calculations that go with it. We just want this little snapshot. So I've gone ahead and done just this. And you can see that it will spit out a matrix. So if you're not familiar with working with this type of functionality in Excel, it can be a little bit tricky. But the line estimation and our first data series is going to be our delta, and our second data series is going to be the lag. And I'm drawing a blank on the 1 and 1, but those are placeholder or not placeholders. Those are as requirements for Excel. And again, I apologize. I'm drawing a
Are
blank.
those for lag or like lead or lag?
It could
Like we
be.
should be right here. That that I think that's
Yep.
maybe what that's for. But.
So calculate this. I typed in A and then A times B. I also typed in coefficient, standard error. This is our sigma, which will come back later. And then DF, our degrees of freedom. Okay, so we're going to need that for our t-stat and our p-value. We really want the t-stat and our p-values, not necessarily for the model itself, just to see if it is a reasonable model. Okay. So next, we'll go ahead and calculate our t-stat, and that will be the coefficient divided by the standard error. So the coefficient divided by standard error, we're going to do that for A and A times B. Our p-value, we're going to use the t-distribution, a two-tailed test. We're going to take the absolute value of our t-stat, and then we're going to use our degrees of freedom. Okay, so this is you can see me making a normal distribution, grabbing those t's, and this is looking at the 5 percentile. Okay, so this is just giving us our t-stat and our p-value. Again, not necessary for the model, just interesting to see whether or not this is worthwhile. Now here's where it gets interesting. So let's look at our A coverage. So we need to do our drift and our long run coefficients. So our A coverage is going to be negative our coefficient, and our B equilibrium is at A times B divided by our A coverage. Pretty exciting. We're going to grab our rate now, which when I had done this, it was a 3.98. And just for the demonstration, 3.98 was the last date that I had. Okay. I have daily data. So our time horizon is we're looking to predict for the next year. So there are 365. You could have used 252 for trading days. Let me change that. See if we like that number. It does drop it down a little bit. So we can go from 365 to 252. We go from 4.46 to 4.42. Okay. And Dr. Rowe, what are your thoughts? Would you rather see the 365 or the 252?
The 252 is the number that I always use, just because when I'm doing things with the option market, I want to exclude the weekends and the days that we have off.
Mhm.
I don't know how that would impact this model, but the days off definitely have impact to derivative models. So I've always been a 252 fan. I've found when you're looking at longer time frames, that in the option space, just like right here, you see very small differences between 365 and 252. Now, if you were doing a 5-day forecast, that's when it really that's really when you want to use trading days versus calendar days.
Sure.
So it's you can use either in my mind, just be consistent.
Yep. Yeah, and this for our model, there's not necessarily the need for being consistent because we're not doing anything with it.
Yeah.
Yep.
So I'm kind of I if somebody shows up at a conference and they're using 365, I'm not going to be the guy that goes, why didn't you use 252? Because I feel like as long as you're being consistent, it's gonna be fine either way.
Yeah.
I've dealt enough of those guys that ask me that question when I'm presenting stuff that I just don't want to be that guy. We
I
don't
think
want to
that
be the jerk. We don't want to be the jerky guy that lives up on the hill.
no, nobody ever wants to be the jerk that lives on the hill,
That's right.
or what I quote the Beatles, or the fool on the hill.
Exactly.
Your way. So, okay, good. So we'll keep the 252. Again, that's one of the nice things about having the spreadsheet. It's really easy to make those changes. We're going to go ahead and calculate our forecast. And now we're going to be using, we're going to take the interest rate now, we're going to discount it back by the equilibrium multiplied by the number of days. And then we're going to add, and if we think about that as our drift, then we're going to add into it our long run, which is the 4.498, and then we're going to discount it back, always discounting everything back. Okay. Pretty exciting, right? And then
Taking it all in the best I can. So, and then
we're going to calculate our variance, utilizing the sigma and the average, or the A coverage, and our time horizon as well. And because it's variance, it's not necessarily as easily understood or easily we can grasp quickly. So if we were to take the square root, giving us a standard deviation, we end up with a volatility of roughly 43%. So we are definitely demonstrating quite a bit of volatility in this, but you can see that we've got an interest rate now of 3.98. I'm going to come over to this here so we can take a look at our time series. We've got a 3.98, and this makes sense because we have seen in our long run average higher rates. So we are then predicting that next year it's supposed to be at 3.98, we'll be at 4.42. Okay. And with that, I'm going to stop sharing my screen because I think this is a good point to transition to whether or not this model actually means anything. So again, very from a math perspective, a calculation standpoint, we can clearly see that this is the long-term average. We've incorporated a drift, all good stuff. But does that really, if we think about what's going on in the economy, do we really think interest rates are going to be increasing? Especially given that the Fed keeps saying they're going to cut interest rates.
Well, the Fed keeps saying they're going to cut them, but the market keeps backing away from that one and keeps pushing out when's the next cut going to come. We just came off of a Fed meeting a couple of weeks this week. Goodness gracious, this week, and a lot of that, or maybe it was last week, but the most recent Fed meeting, it was funny because all the headlines were the Fed's putting rate cuts on hold. Yeah, no kidding. The
Yeah.
derivative markets have been saying that that's what's going to happen for 3 or 4 months.
Right.
So where I think this would be really interesting, and I think you and I are going to have some fun with this. I can get the derivative data, the predictions that you get off of Bloomberg. I can get the historical predictions, and we can see how this model would have done versus what actually ended up happening. And do the derivative markets do a better job of predicting what's going to happen than other models?
And the best.
I strongly count on the derivative models, but I can tell you that they change. And if if we get some sort of inflationary data and it makes it look like the Fed doesn't have as much flexibility with cutting rates because cutting rates could make inflation worse, you'll actually see the odds of a cut at some of the next few meetings go down, and where the odds show that the next cut should be pushed out a bit.
Mm.
And so the market has it wrong sometimes. The way I really do think, and I've seen some very large trades that have not quite worked out, but you see large trades sometimes in the interest rate derivative markets that will benefit if the market's wrong.
Mm.
And finding a model that does a better job of predicting where the T-bill rate, where the risk-free rate's going to be, than following the derivative markets. Maybe we could quit our academic careers
Maybe.
if we if we're able to do that one. And then the other thing with this one, because it's I wonder if you could use it to predict VIX. That's all.
And
I just wonder that. That's all.
and with that is definitely something we can look at, is whether or
Yeah.
not use it to predict fix. There are also extensions of this model that we're not going
Yeah.
to go into today. And that would also be fun to talk about some extra factors that we could put in.
So, both Steph,
But
I feel like there's some other markets we can apply it to as well. I like how you're taking something that really the use of it, at least the way I've seen it explained in the literature, is more of just trying to value your portfolio of bonds based on where you think interest rates are going to be in the future, et cetera. Actually predicting the rate, I think that's an interesting deviation on this one, and one that a lot of academics don't think about because they're not thinking about predicting the markets.
well, and in full disclosure, what we did, and we don't have time to do this now, but we even took this model with the students and then ran a Monte Carlo around it. Because in the model, you have to build out that standard deviation. So because you have that, you can then pull those better random values. And take a quick look. We're looking at a 4.46, at least as of this moment. If I hit enter again on my Excel spreadsheet, it will change.
Well, and I think and that's a year out.
Mhm.
I think that's a little bit. I think right now the derivative markets are looking at about 4.75. So that's pretty much in line.
Wow, there you
That's
go.
they're looking for a couple of. We're at 5.25. They're looking for a couple of cuts between now and the end of this year. So
Okay.
at least last time I checked it, and so that you're pretty much in order. We need a number that deviates an awful lot so we can get out there and do some trading.
That would be nice.
Yeah,
Well, we need it to deviate and we need to be right.
that's true. So.
But yeah,
And
but
I guess testing is going to give us the confidence on that one. So there you go.
absolutely. Well, with that, we thank everybody for joining us. This has been just a pleasure of walking through another model. If it's possible, we'll see if we can post these models for you. I don't know if that's possible.
I'm gonna look. I'm gonna look on our LinkedIn and see if there's a way to link. There's a place to link files.
Okay.
I'll do something. I'm our producer IT person, so I'll figure it out.
Excellent. But the goal was to give you a jump start if you are looking at these models and just understanding how to use them. With that, thank you so much. If you like this, please hit like and please subscribe. And as always, thank you so much. And thank you, Dr. Rowe.
Yeah, thanks a lot.